Good morning and welcome to the CT Global Managed Portfolio Trust PLC Investor Update. Throughout this recorded update, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time just by using the Q&A tab that's situated on the right-hand corner of your screen. Type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Peter Hewitt. Good morning to you, sir.
Good morning, and good morning, everybody from sunny Edinburgh. And so today I'm going to talk about the CT Global Managed Portfolio Trust, and we'll look at some of the key attributes of the trust, certain features that are kind of unique to this trust, I think. And then we'll look at how the trust's been doing in terms of performance, valuations in the world of investment companies, and then actually look at the portfolio, what I've been buying, what I've been selling, what are the major holdings, and also really what are the key themes I'm trying to tap into for 2025. So let's begin, and I'll just get this for you now. So key attributes here. We've tried to use the capital structure of an investment company to really try and customize the returns for shareholders. So actually, within one investment company, you've got two quite separate share classes that are not linked. They are linked in one way, but other than that, one is geared, one isn't. And they have mainly different holdings in them. So there's a growth class, which is for capital returns only, and an income, which is for a high and hopefully growing level of income with some capital growth to it. But for the next couple of minutes, I'm going to the three bottom points there about income transfer, a conversion facility, and how we control the discounts on the shares. I just want to touch on these before we get into some of the other areas. So this one here, this is unique, and so it's a bit difficult perhaps to convey to you, but it's been massively important for this trust since we launched in 2008 right through to today. And what happens if you can focus on, there's three boxes here, focus on the growth pool, and you'll see that at the top there, I've got investments at the start of the period, 100. Let's assume we're at the beginning of a year and both portfolios are valued at 100. Let's also assume there are no changes whatsoever through the year in share prices or holdings or whatever, which is highly unlikely, but there we are. So the growth portfolio over the years right through to today has yielded somewhere between 1 and 1.5%. I think it's currently about 1.4. So not much dividend yield. I'm focusing on trusts which have got hopefully some real capital growth potential. So if you follow down there where it says dividends received 1, and you'll then see a -1. And that's quite interesting because that is the dividends received over the course of a year into the growth pool, and they then get put on a conveyor belt. So for example, Scottish Mortgage, which is a holding of mine, it's got a dividend yield of 0.5%. It pays its dividend. It gets put on this conveyor belt and gets moved across to the income pool. And you can see there that -1 appears as a +1 in the income pool box. And at the same time, the same amount, it says capital transfer to growth pool, is actually then put on a conveyor belt back to the growth pool, except it's called capital, not income. So what effect does this have? Well, you can see there, you don't get any dividends if you're a growth shareholder. It's capital growth only. But if we started with a net asset value of 100, we finished the year with a net asset value of 101 in this unrealistic scenario of no share prices changing. So you get a slight uplift over the course of a year to the NAV of the growth pool. What does it do for the income pool? Well, the income pool has typically had a dividend yield of somewhere between 4.5, a natural yield. But what this does is it boosts that dividend usefully. I mean, at the moment it's close to 1.5%. And you could see there that the dividends paid out to income shareholders, I said -5, they get a boost. It's probably a bit higher than that now, in fact, quite a bit higher. But what also happens is the asset value of the income pool is reduced. So your asset value, it started at 100, finishes at 99, but you get a higher dividend yield than you ordinarily otherwise would have received. There are no adverse tax implications. All the Inland Revenue sees is the box on the right, what we generate in dividends and what we pay out. So that transfer of income, it's actually quite small, but it's actually been really important, particularly for the income pool. And it's meant I've never really had to chase higher yield over the course of managing this. And it's certainly bolstered the revenue account of the income pool. So that's the income transfer. It's just customizing returns a little bit more to capital for the growth pool and more to income for the income pool. So the other thing I wanted to mention was our conversion facility. And that happens annually every year in October. Our AGM is normally at the end of September, beginning of October. And it means that investors can switch between the growth and income portfolios at net asset value. And we do have to set some minimum and maximum levels of this, but we've never actually had to really enforce them. And the last few years, it's been gradually building as people have become more aware of the fact that they can move from one to other. And actually, it's almost cost-free for the shareholders. The trust actually picks up the costs, which are mainly legal and accounting costs of this transfer happening. And so it's not treated as a capital gains for tax purposes because it's within the one company. Remember, we are part of the managed portfolio trust, happens to have two separate share classes, so you can shift between the two. And at the moment, the income has proven slightly more popular than growth, but there are movements both ways. And actually, what this facility allows you is to, over the course, if you're a long-term shareholder, you can change your preference between growth and income. So ideally, if you were younger, you probably have more, you're keener on capital growth and want to see the value of your investment rise. But there comes a point, and it's different for everybody, when income becomes more important. And if that's the case, you can transfer some or all of your holdings from growth into income. And that's proven to be quite popular with investors. So that's the income transfer, the conversion facility, and the last thing, as I said, tight control of discounts. And this is just a discount chart for you of the, that's of the income pool, of the income pool over the life of the trust, which started in April 2008. And what this tells you is actually we keep the discount stroke premium pretty close to asset value. So over most of the last few years, the income has actually been selling at a small premium. Today, it's actually at a 1% discount, which is unusual, but it's been fairly steady, and you can see there, the last 10 years, it's been mainly at a small premium. And the same with the growth portfolio. It's actually on a slightly tighter discount at the moment. It's on a discount of only 0.5%. So they're both trading pretty close to asset value. And that's achieved through quite a robust and rigorous policy of buying in shares, share buybacks. If the discount gets towards 3%, we're looking to buy shares in. And similarly, if we need to issue shares, they're issued at a small premium, between a 1 and 1.5% premium, and that often happens too. So between buying in and issuing, you can keep the share price close to asset value. And I think that's very important, because the last thing you want in a vehicle like the Managed Portfolio Trust is a double discount coming, because the underlying holdings that I have, and I'm going to tell you about this shortly, are at discounts. We don't want the Managed Portfolio Trust to be at that. And over the period, we've actually managed to keep it pretty close to par. So this is just a brief summary for you of what the Managed Portfolio Trust is. We launched 40 odd million of assets, 2,300 shareholders, the Columbia Threadneedle retail plans, and that's all individuals, and they own about 75 to 80% of the growth portfolio and about 60% of the income portfolio. That's been a significant source of demand over the years, as have the platforms, Hargreaves, AJ Bell, Interactive Investor. And you can see over the last 10 years, we've probably issued about £50 million of shares between both growth and income. But we've also bought in shares. And actually, in the last 2 or 3 years, we've had to buy in quite a few growth shares, not really in income at all, where there's been a continuing demand. So today, you've got assets of somewhere between 160, 170 million and pushing 16,000 shareholders. So that is a lot of shareholders. And there are no institutions, there's hardly any private wealth shareholders. It's all individuals. And actually, what that tells you is people have got quite 16,000 on 160 odd million, tells you the average size of a shareholding is 10 to 12,000 pounds. There are a lot of people who are shareholders in this trust, and it is their only exposure to equity markets. So that's quite salutary for me. I don't go overboard in terms of risk, but it tells you lots of small shareholders. There is nobody with a declarable stake or indeed anywhere near it. So here we've got a chart which just shows you, this is to put performance in context. And this is the total investment company subsector within the all-share index. And it's basically divided by what's happening to the all-share index. So the way to read this is quite simply, when the line is rising, investment companies are outperforming the FTSE index. When it's falling, the reverse is true. So this is a 10-year chart. And you can see for the first 5 years there, from 2015 through to 2020, and actually before then, really from about 2012 onwards, investment companies were gently outperforming the average. They then had a really good year in 2020 and 2021. But right at the end of 2021, interest rates started going up. And that really put the skids on the investment company subsector. And you could see a very marked underperformance in 2022 and 2023. As interest rates rose, inflation went up, and discounts widened sharply, which I'm going to come on to just now. And so the last 18 months has been a mixed period for investment trusts. You've had periods of really quite strong performance. For example, I would highlight November, December of 2023, when the thoughts were interest rates were going to come down quite sharply. Investment companies pushed on strongly and had a great period of performance. That then kind of frittered away over the first half of 2024, but round about the general election, July, August, strong performance again from investment companies. And again, most of that's been given up. They had a good December. January has not been so good for investment companies. So at the moment, they're kind of going sideways against the mainstream index. But that puts in context for you how investment companies as a whole have done. Now let's just look at these two charts, which kindly have been given to me by Winterflood Securities. And the one on the left is quite a useful one because that shows you the average sector discount for the investment company subsector over the last 10 years. And again, if you just look at the green line there, it gradually tightened over the first 5 years of our period. And a couple of times, just before the COVID epidemic, and actually in 2021, the sector was trading almost at a premium. The line down, by the way, in March 2020, that's all due to COVID. And you had a big fall and then a big rise in the discount in March, April 2020. But more importantly, look at what happened in 22 and 23. As I said, interest rates rising, fears of recession, inflation higher, and discounts widened very sharply. And the average sector discount went from, I think it was 2 at the end of 2021, beginning of 2022, to 19 in the autumn of 2023. And since then, again, it tightened slightly, but it's still around about 15% today. And you can see in the chart on the right-hand side, that's a shorter term chart. I think it's just over the last couple of years. And there we are. We're still at round about 15. And so historically, that's a very wide level indeed. And so you're buying £100 of assets for, on average, £85. That seems like a good idea. But we need to have confidence that discounts will begin to come in. And there's a whole series of factors that are at play there. But that puts in perspective for you the underperformance recently of the sector in general and where we are just now in terms of valuations. And so that's translated through to performance for the managed portfolio trust. And I've given it quite long-term stuff here, 1 year, 5 years, 10 years to the end of December. And you can see the 1 year number, the all-share index was up 9.5 last year. That's not bad. It's not as good as some indexes, or particularly America, but it's still reasonable. And the growth portfolio was pretty much in line with that. The income portfolio lagged, and I'll come on to reasons why there. The 5 year numbers are the ones that encompass that big fall in 2022 and 2023, where you just couldn't, I mean, when discounts go from an average of 2 to an average of 19, share prices are underperforming, and you can see there. The 10-year numbers, a bit better, particularly for the growth portfolio, and both of them, since the 17 years we've been running this, have actually are at or slightly ahead of the all-share index over that time. Interestingly, the shorter term performance, the 7 months, we have a May 31st year end. So this is for financial year to end May 2025. You can actually see that the income portfolio is more or less in line with the all-share index. The growth portfolio actually is slightly ahead of it, which is encouraging. And then this next page, I'm not going to spend long on it. That gives you each discrete year's performance. It's a blizzard of figures. It's difficult to focus on. I have to put it in for regulatory reasons. Just make a couple of comments on it. Looking at the growth portfolio, actually from 2013 to 2021, it beat the all-share index every single year, 9 consecutive years. And then in 2022 and 2023, the underperformance was really quite marked, and a lot of that was given up. The income portfolio has also had quite a good run, but similarly in 2022 and 2023, with discounts widening, it's underperformed. But it does show you actually that we do outperform in reasonable markets, and that's what we're trying to do just now. And then I've got a page here for you just on the income portfolio, and this just gives you a flavour of current dividend yield and where we're at. And so the yield on the all-share index as we speak today is just over 3.5, between 3.5, 3.6. I've got there the yield on the all stocks index, which is government bonds, just for a yardstick for you. It's roughly 4.95%. The yield on the income shares currently is 6.7. Now, they're trading at a very modest discount of less than 1 at the moment, but you can see there the dividend record, and we've managed to increase the dividend every year, I think, since 2011. So we're actually, the Association of Investment Companies have a category called Next Generation Dividend Heroes, if you've managed to increase the dividend 10 years running. And we've done that. And we're continuing to do that this year. And in the first half, the dividend's gone up by roughly 2.8%. And the objective is to try and keep that going through the rest of this financial year and indeed beyond. Other thing I'd like to mention is the income portfolio has a decent level of revenue reserves, something like 2/3 of 1 year's dividend payment. So that should give you confidence to the future outlook for dividends. And I can tell you the revenue coming through from the underlying holdings really is quite good at the moment. So now, I just want to start off looking at the portfolios and looking ahead now, key themes for 2025. This is a busy slide, but it's absolutely vital I spend a little bit of time explaining to you what's underlying the portfolios at the moment. There are 3 key themes, and the first one is UK equity trusts. And candidly, I've had this going for just over a year now. It's not really worked so far. And I think the UK market, as you perhaps know, is quite inexpensive in an international context and also against its own historic range at the moment. It's been out of favour for years, really since the Brexit referendum in 2016. Global investors have withdrawn from the UK, and also pension funds not investing in UK equities. They hardly hold any now. There's been lots of sellers and really not that many buyers. And there's lots of really quite attractive discounts at the moment. Just before we started this, I looked at, there's some of my big holdings. Fidelity Special Values on a 9 discount. Law Debenture much tighter, it trades about par. Aurora's on a 10 discount. Smaller and mid and small cap companies, Aberforth Small is on a 12, Henderson's on a 13, Mercantile on an 11, JP Morgan UK smaller companies is round about 10 as well. These are really quite wide discounts for listed investment companies. And that's why I think it's interesting, because the UK is out of favour. It's cheap, particularly mid and small cap companies are cheap, and that's the 250 index and the small cap index, and to some extent the AIM index as well. So valuations are cheap, and the domestic economy has been pretty much written off. And, when the general election happened in the summer, you thought, well, whatever your views are, hopefully we're in for a period of relative calm. Far from it, and the government's had a series of own goals, and growth has pretty much flatlined throughout the autumn and the winter. However, looking forward to next year, and provided there are no more big tax increases from the Chancellor, and she's pledged she's not going to do that, actually growth in the UK does begin to pick up. And why, if there's all this negative sentiment, am I saying that? Well, I would point to 2 key things. And the first thing is employment numbers have stayed relatively firm. Unemployment actually went up slightly this morning in the most recent numbers that were announced. But you've still got relatively full employment. But more importantly, real wages are growing. Again, numbers out this morning, up 5.6%, inflation's 2.6%. Now, remember, a couple of years ago, inflation went up to 10 or 12%, and, wages obviously were lagging that, so it's a loss of real purchasing power. The reverse is true now, and most people are actually in a job and getting wage increases which are growing in real terms. That's important, because the UK economy is a consumer economy. And that's about 70% of the economy is consumer based. So you've got the fundamentals there, which actually are quite positive. And the one thing that's happened actually in the autumn, and of course it would be a negative if it continued to happen, is UK consumers have been saving more. They've not been that willing to spend. So we have to see that changing. And my feeling is, as we move through this current year, it will gradually change and you will see more spending. And whether that's on housing, holidays, restaurants, wherever. And I think that's quite a good backdrop for the UK. The other thing is government spending. As we know, they've raised taxes, but they are spending a lot more on the health service, education, and that does feed through into the economy as well. So the backdrop for the UK is actually not as negative as is made out. And most forecasters are actually saying the UK economy will grow slightly faster than Europe. Now, not very fast in comparison to emerging markets or America, but still growing. So I think the backdrop for UK companies, UK investment companies is quite interesting. And particularly mid and small caps, Aberforth on a 12 discount, that's historically at one end of the range. You get decent dividends as well. So although there's a certain fatigue amongst investors saying, oh, the UK is cheap, etc., but it's still not performing. It's actually not performing any worse than any of the other non-US markets, and sometimes a bit better. But remember, you're buying into a market that is grossly undervalued in comparison with Europe and actually other overseas markets. So I'm sticking with UK trusts, and hopefully they'll come through this coming year. Private equity trusts are on very wide discounts indeed, 30% plus. Most of the names there, with the exception of HG Capital, are really on quite wide discounts. In some cases, Pantheon at the moment, almost a 40 discount. Now, those discounts ballooned out in 2022 when the fear was interest rates going up, but more especially, oh, we're going to have a recession. So the asset value of a private company, which was 100, isn't going to be 100 in a year's time. It's going to be 90 or 80. So the discount's wide just now, but actually the real discount a year out is a lot narrower. Well, a recession didn't happen, but those discounts have remained. And the private equity trusts are very interesting. Most of them are now beginning to produce some growth in their asset values, which broadly speaking went sideways for a couple of years. And that's because the environment for realizations is improving substantially. That means buying and selling of private companies. And that's great news for this sector. And in the long term, some of them have got wonderful records. Pantheon compounded its share price return, I think it's 12 or 13% per annum since it launched in 1987. That's not too shabby. You need to have some of these in your portfolio, and they are, you're paying 60 pence for assets, good assets, which are growing of £1. So I like private equity trusts, and I think hopefully they will come through also. And the final one there, trusts with secular growth characteristics, and you can see the names. And what I'm really meaning there is technology in particular, and some of these, and this is an area that has really delivered last year, and it's continuing to deliver in January, February. Alliance Technology Trust, Polar Cap Technology have moved strongly. They are at discounts still of 10 or 11%. One trust I've been adding to is Scottish Mortgage, and I attended their annual seminar last week in Edinburgh, and that is a trust. Everybody knows it's the biggest by miles. It's on the front foot now, and a lot of its holdings are coming through quite strongly, particularly the private ones, which were under a lot of scrutiny 2 or 3 years ago. Now they're beginning to deliver, biggest one being SpaceX, the Elon Musk company, and that really is firing on all cylinders. So I like some of the names there. Healthcare has actually underperformed quite sharply in November and December, And all I can find is it's to do with the new individual who's in charge of the health sector in the US, who's got quite an interesting past. So let's hope there's no future regulatory hurdles there. I suspect there probably isn't. But please note, in terms of biotechnology and healthcare, mergers and acquisitions have started to pick up again in that sector, and that's good for share prices. So I'm definitely sticking to having a big exposure to trusts with secular growth characteristics, because over the long run, these are the ones that really deliver performance for you. Here are the growth portfolio, the top 10 holdings, and that reflects hopefully what I've been telling you. You see some private equity, HG Capital, which is mainly exposed to software companies in the UK and Europe. Oakley Capital also been a great performer. That's on a 30 discount. You can see Polar Cap Technology and Allianz Technology there. Some of the best UK names, Fidelity Special Values, it's done extremely well. But it's been exposure to US assets, particularly the US stock market, technology companies, JP Morgan, American, Scottish Mortgage, Monks. They've all delivered very strongly and are continuing to. And yet Monks is on a discount of nearly 12. Interesting. So I've tried to reflect these themes in the main holdings. Not actually been doing that much in the fiscal year so far. Added a bit to JP Morgan, smaller companies, capital growth and income. Also to Henderson smaller companies. You can see there on 3 occasions I've added to Scottish Mortgage. And I think Scottish Mortgage is looking very interesting at the moment. And then on the sales side, Artemis Alpha was subsumed into Aurora, which is, there are both holdings in the portfolio. I continue to hold Aurora. I like Aurora. It's quite a high beta, got a very focused portfolio, but a good management team at Phoenix. So we like Aurora. And you can see there some of the other things I've done, taken some money out of some of the more defensive trusts, capital gearing, and personal assets, and redeployed it into some of the areas earlier, like Scottish Mortgage and UK small cap trusts. I did top slice HG Capital, and that's simply because it had done so well. It was becoming a very large holding indeed. So it's back to about 5% of the growth portfolio. It's the biggest holding. And so the income portfolio. So what I've been saying to you about some of the key themes, the income portfolio, because it needs investment companies with dividends, can't really get exposed to Allianz Technology or Scottish Mortgage or Polar Cap Technology, simply because they don't pay dividends or very small dividends. So the key reason it has been behind the growth portfolio has been it hasn't had exposure to the US equity market and in particular the technology sector. So there you can see the names I've got in the income portfolio. You can see Law Debentures, one of my main holdings, and I like that. That's delivered some really good. The one area, the one holding, JP Morgan Global Growth and Income, actually does have some exposure to the US equity market, and hey presto, that one has been one of the best performers. And it's able to do that because it pays out a dividend of 4% of net asset value each year, and roughly about half of that comes from underlying revenue and half of it comes from capital. So that affords it the flexibility to own lower yielding companies, principally in the US. So JP Morgan Global Growth and Income has been a key holding. You can see private equity there with NB, Private Equity Partners. I've also got a couple of other ones, Apax and Partners Group, private equity, and they pay dividends from capital, and it's a great way for an income portfolio to gain exposure to private equity assets. You can see some global equity income trusts too. Murray International is key in there, and along with some core names like Merchants Trust and importantly Mercantile, and I really like Mercantile. And I think if mid and small caps start performing, so hopefully will the likes of Mercantile. And you can see one holding there I've got in secular growth is International Biotechnology. They pay out a dividend, again from capital, of 4% of net asset value. And that one has actually performed extremely well. It's now in the top 10, and it's one I've added to. So what have I been doing in the income portfolio? Well, you can see there, similar theme to the growth portfolio. I've been buying a little bit more private equity, some secular growth with international biotech, small companies. I've also been buying TR property. I like it. It's an extremely well-run trust, and it's my main exposure to property is via TR property. However, whilst bond yields are rising, as they have done in both the US and the UK over the autumn, then property just doesn't perform. And the outlook for interest rates, perhaps a bit lower, perhaps in the UK, maybe a couple of cuts. Not sure about the US, depends on how strong the economy is and what happens to underlying inflation. So TR property is yet to perform, but I think all we need is a bit of stabilization in bond yields and perhaps an interest rate reduction, along with the economy not going into recession, but beginning to grow. And you could see hopefully some decent performance from that part of the market. And these are ones I've been selling. Some of them are good companies, just lower dividend yields. Japan Income Growth will be a core holding. So will Scottish American. I like them. And they've got a low dividend yield. So I just sold that because we have to have some level of income producing companies in the income portfolio. And so it's just beginning to round off your prospects for 2025. So you can see there, I think the outlook is for corporate earnings growth to be very strong in the US, 14%. That's just a consensus estimate. I've got no particular axe to grind there. That's where the strongest growth is. In Europe and the UK, it's both plus 6 or 7 from basically being flat in 2024. But what you need to have a look at are valuations. So when I say the US forward PE is almost 22, that is consensus estimates for 12 months' time of all the companies in the S&P Composite Index. And that's a forward PE of 22 against a long-term average of about 16. Europe, about 14. The average is about 14. The UK, 11, and the average is almost 14. So that does, put into context for you how attractively valued the UK is. And now at some stage, I think you will see the UK assets beginning to perform, but it's not happened yet. However, it's cheap underlying assets, and I would rather hold that than be in an expensive underperforming asset. Inflation's sticky. I've got not much to add there. I don't think we're going to get anywhere near 2% inflation. My feeling is probably somewhere between 2 and 3 for most of the developed economies seems likely. There is a risk if the US economy grows too fast and inflation picks up, that bond yields begin to pick up in the US. And at that point, you could find the US market coming under pressure. But I've outlined for you my 3 key themes, which I'm sticking to just now. And so, I've just got this one slide here for you. And these are from holdings I've held for a long time, the growth portfolio. And it's just to underline, so why does he keep holding secular growth trusts in technology? And here's the reason why. Because the Alliance technology, I've made 10 times the money since 2008. Polar Cap technology, pushing 8 times the money. And, you can see there some of the returns. JP Morgan American is a 7-bagger. Biotechnology Trust is a 4-bagger. And Herald, currently in the focus with what's going on with Saba just now, Herald has made, well, there you go, 3.5 to 4 times my money since I bought it in 2008 or 9, I think it was. So that just shows you, keep holding these trusts because these are the ones that deliver really big performance in the long run. And just to summarize, you can see there, so the income portfolio, you get a 6.7 yield with some capital growth. Hopefully that will pick up a bit, particularly if UK equity trusts begin to perform. And I should say in the income portfolio, the other drag on performance has been some of the alternatives, in particular, a couple of the renewables trusts I've got, wind farms, solar farms, Greencoat UK Wind and Renewables Infrastructure Group. They have really underperformed. They're on wide discounts now. Renewables Infrastructure is on a 35 discount, Greencoat UK Wind on a 25 discount. And they're both yielding between 8.5 and 9, and dividends are growing. So that's a difficult one. From an income perspective, you really want to hold them. But from a capital growth perspective, the share prices are extremely sensitive to what is going on with bond yields. And I've said bond yields have risen over the autumn. The 10-year yield is now 4.6, 4.7 in the UK, up from 3.8 in September. And what that means is share prices of these types of trusts have fallen quite sharply. And simply put, when you have assets or wind farms, which do generate good cash flows, they generate long-term cash flows out maybe 15 or 20 years. And the way you value these assets is by then discounting those cash flows back to the present day. And it's the discount rate that's used. That has gone up quite sharply, which reduces the value of current assets, apparently. And so that's been reflected in the share prices. And they're now at quite wide discounts. So a lot depends on where you think bond yields and interest rates are going for those for those holdings. I think now on those type of dividend yields, I'm not going to sell them because I think there is some quite strong dividend growth to come through and hopefully some capital performance once bond yields stabilize. So hopefully that gives you a flavour of what I've been doing in both growth and income. And I think we can perhaps move on to any questions that may or may not come up.
Yes, indeed. Thank you, Peter. My name is Peter Brown. I work with the investment trust team at Clumber Threadneedle. Thanks for that very detailed presentation. We do have some questions. We'll start with the theme of the day, shall we say. The question is, I would be interested in your thoughts on the current moves by Saba Capital Management within the UK investment trust sector. At the time of your last annual report, there are at least 2 holdings of investment trusts in the growth portfolio that are in the initial 7 investment trusts that Saba are currently focused on. You've mentioned Herald being one. I wonder if there's another one in there. But what are your thoughts on the actions?
Okay, well, yep, I've got 2 holdings, Herald being one I've held for a very long time, and Henderson Opportunities, which is a smaller UK equity trust, which is run by James Henderson and Laura Fall. And so I voted against the Saba requisition EGM or their resolutions that they put forward. And I have to say, I did find Saba wholly unattractive. You know, there's a whole series of things we could talk about here, but I didn't want to lose the mandates. Firstly, particularly Herald, which invests in small technology companies in the UK, quite a bit in the UK, 40, 50%, some in America, some in Europe, great long-term record. Why would I want to lose that? Just over, you know, the discount was in the mid-teens. It would have been good if it was a bit tighter. But actually, if you look at the returns over the long run, discount just pales into insignificance in terms of the when you compare it to the asset value growth we've had from that one, and to some extent too with Henderson's. So there's a number of points to make. The governance that Saba are putting forward, which is their own people to go on the boards, that's horrendous. That's just against all the governance guidelines in the UK. Nobody has really focused on Saba run two, what they call in America, closed-end mutual funds, which they've run for a number of years, and they both sell at discounts of kind of 8, 10, 12%. Pretty ingrained discounts at that. So why are they not doing anything about that? And perhaps that tells you what might happen if Saba got in control. And that's what they want, is control, to change the mandates and try and have an activist trust in the UK which exploits other discounts. But it itself could easily move to a discount. In fact, it almost certainly would do. I have yet to come across any other investors in private wealth, multi-asset, even individuals who've been convinced by the Saba proposals. So, I voted against them. I think it will probably be quite a close thing because they've got lots of money. Their hedge fund, it's all borrowed, it's highly leveraged. They own nearly 29% of, I think, 5 or 6 of the trusts, and a bit less of 25%, I think it is, of Edinburgh Worldwide. And actually, the performance of some of these trusts has really been quite good. The European Small Companies one that Henderson's run has been really quite decent. Baillie Gifford US Growth produced interims this morning. The S&P index up 15, Baillie Gifford US Growth up 29. Yeah, why do you want to lose that? Of course, they had a difficult couple of years. That's what they're exploiting. They focused on the 3-year numbers. I told you my 3-year numbers aren't very good, and that's because of what happened in 2022 and 2023. But look longer term, and the numbers from Herald or Baillie Gifford US Growth are really quite good. And so I think they've been very selective in the, the performance yardsticks that they've looked at. So we will see. The other thing I would say, just to round off on Saba, and I suppose it's actually quite a positive side effect, is it will be another factor which hopefully will lead to narrower discounts. We don't want to see discounts, particularly on listed equity investment companies, in the mid-teens. And I think that's been a signal to boards that they're probably going to have to be a bit more. They have bought back shares, lots of trusts do, but they're going to have to be, perhaps by quantum, be much more aggressive in order to keep discounts narrower into single figures. I do it with the managed portfolio trust, so it's not impossible if you really have some resolve there, and that could be a decent side effect of what's been going on.
Yeah, interesting. It's going to play out in the next few weeks and months. But one of the biggest questions is what they're going to do with their positions if and when they do fail to get the votes they want. But that's for another day. We'll move on to something a bit more specific to your trust. One of the questions is, with the rise of passive investing, how do you position the trust to highlight the benefits of active management?
Well, that's a good question, and I try and highlight the benefits of active management. And you could rightly say, well, if you look over the last 2 or 3 years, there's not really been much benefit of active management. And that's true across the entire industry, really. And one of the reasons, in fact, I would say the key reason, is leadership within the market, within the UK market. Also, the American market and actually European markets are also the same. And so what I mean is the FTSE 100, the biggest companies in the UK, and actually within the FTSE, the top 20 companies, so the biggest companies, have been the ones that have performed. 2022 and 2023, fear of recession, uncertainty in other areas, people tended to move towards bigger companies, which perhaps had more solid finances and would see themselves through recession better. And so when the likes of a Shell, which is 7% of the all-share index, or Hong Kong and Shanghai Bank, or other ones too, AstraZeneca, there's a few very big companies in the UK, when they perform, when they lead the market, it is very difficult for active fund managers to outperform. You'd have to have 10% in Shell, 10% in the Hong Kong Bank. And I think investors want a level of diversification there, not all their eggs in one basket. Now, if this was to go on indefinitely, then they would have to consider that, and passives might be a way forward, because that's what dominates. The FTSE 100 is 85% of the all-share index. However, if you look over the long run, it's been the 250 index for mid-caps and the small-cap index, which actually have got the best performance records over 10, 15, 20 years. That's been there. It's much easier to grow double the size of your company when you're a much smaller company than it is for Shell or a big bank or a big pharmaceutical company. And so that's what we need to see. But whilst there's been doubts over the domestic economy, and these mid and small caps have overseas interest, but not nearly as great as the FTSE 100 biggest companies, that's been the problem. And so you heard me talking earlier about the UK economy. I think it will modestly start growing again next year. That's enough. Profits and earnings will start moving forward, and these are very cheaply rated companies. In the great scheme of things, you're getting some super value there. When sterling falls, the immediate beneficiary are the huge overseas earners, which are generally the very biggest companies. So, so far we're at the 21st of January. The FTSE 100 index is up 4.5% this year. The FTSE 250 index is down 0.5%. Small cap is down 1.5%, and investment companies +1, slightly better, but behind the all share. And so that is the key thing for active fund managers. If mid and small caps and even smaller companies within the FTSE 100 start to perform in terms of their share prices, active fund managers will perform. And all I'm saying is you're getting this at discounts of 10, 12, 14%. I think that could be quite interesting.
Lovely. And specifically in the portfolio, a simple question from someone. Why did you sell European Assets Trust, EAT?
Well, that was performance. It's didn't really perform all that well, to be honest with you. And I've got some other European holdings, which I have preferred. In Europe, what I've been saying about small and mid caps does also happen in Europe. They've underperformed the stocks indexes of bigger companies. But there's just a fear, particularly with Germany, that actually it's been in recession, flirting with recession. It's not been a great environment for small and mid caps in Europe. And although things could change, if you get a resolution to what's going on in Ukraine, that is quite positive for European economies, probably European stock markets too. But until that happens, the likes of Germany, which is very export orientated and not been doing that well, and some of the other big economies, neither has France. There's been a lot of political uncertainty in both Germany and France. So I kind of pulled back a bit in Europe. I'm now looking at Europe, yes, as a potential at some point, hopefully later this year, but not quite yet.
Lovely. Question about the US new government over there and the new president. Given the arrival of Trump administration and the rising global political tensions, could you see an increasing role for wealth preservation trusts such as P&L, CST, and RICA in your income portfolio?
Yes, is the answer. They've actually been mainly in my growth portfolio. I've sold rougher, sold capital gains, capital gearing. I've still got personal assets, and I've still got another one called BH Macro, which is, let's just say, a contrary indicator. When equity markets fall, it does quite well. And I sold them actually last year in the belief that interest rates were coming down and, equity markets would pick up. I would go back into these ones again, and the scenario for that probably would be US growth becomes too strong, inflation starts ticking up in America, and even though profits and earnings announcements from companies might be very good, if that meant the Federal Reserve weren't going to be cutting interest rates, and in fact, if markets moved ahead to 2026, they saw interest rates having to go up in order to quell inflation, that would put the skids under the US market, and you'd want to have some of these trusts. Capital gains, a well-managed trust, I like it. Rougher is too. I've got personal. I would increase all of them again to decent levels. Not quite there yet. And also, I would say the UK would be affected, but is slightly differently positioned. I don't see growth being too strong in the UK. I think inflation will go round about 2.5% to 3%. And once again, you've got a price earnings ratio of 11. And lots of underlying companies, the price earnings ratio of the Lowland portfolio is 10, of the Aberforth portfolio is 9. That is really quite inexpensive. So do remember that. But yes, wealth preservation trusts in an adverse environment definitely have a role.
And we're getting towards the hour now, so very briefly, and you have covered this basically across the last hour, but the question is, what sectors or regions do you see the most attractive going into 25? Are there any underrepresented areas you're looking to increase exposure to? I think you've covered it, but just a 30-second summary of what you've said.
Yep. Well, my three key themes. I mean, UK equities we've got investor fatigue here. It could do with performing. Just as a wildcat, I mean, I was asked earlier about Europe. Europe is, the sentiment is awful in Europe, but that could change. And it may be something like a resolution in Ukraine, a German election happening could change it. And so who knows, we might be looking to increase Europe in the future. Similarly, with tariffs and Trump, let's look at Asia and emerging markets. Not really been a feature for long enough, but it's a great growth area of the world. And once once you have certainty as to how bad these are going to be, then the markets price things in. And it may be that there's opportunities in these areas, but not yet.
Lovely. And finally, your closing comments about the trust and why people should support you.
Well, it's, the underlying discount on the growth portfolio is 13, and on the income portfolio is almost 12, which is as wide as either of them have been since I've been covering that. So they have been out of favour. They are inexpensive, and I think it's a great way. I position this as a long-term savings vehicle. That's what I do. I save into both growth and income every month. And I think it's the best way to do it. And I think if you want capital growth, we try and deliver that for you. And I've done a reasonable job. The income portfolio has done well on income. And provided we can get a little bit of capital growth there, I think that could give you some decent returns too. So I feel that the year we're entering, hopefully, should be a more productive one for us all.
Perfect. Well, I'd like to thank you for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT Global Managed Portfolio Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.